Hi, this is Barry Brooksby. When someone thinks of saving or investing money, they usually think about the stock market. And for most people, they're investing in a 401k or an IRA, a stock or a mutual fund or something similar, but it's usually tied to the stock market. I want to go over what the reality of that for a lot of people really ends up being. So I'm going to draw here a pool of money. And imagine if this pool of money represented the stock market. And again, we've got 401ks, IRAs, traditional stocks, or mutual funds. When someone is saving and investing money in the stock market for their entire working life and even through retirement, as money is going into the stock market, every dollar is subject to interest rates or a rate of return. It doesn't matter if it's bonds or stocks or mutual funds. That pool of money is relegated to interest rates for a lifetime. Now think about that. When someone retires, they've built up this net worth, this nest egg, this pool of money. They now start taking income from that pool of money in retirement. What happens in a down year? What did people do in 2008 when the market crashed, but they still needed income from their investments? They had to take money from that down account. Adding insult to injury, they're now taking income from an account that has lost value, and in some cases 30, 40, 50% value. They're taking income from that down account. So it's extremely painful, and it erodes the account even further when you have to take income in a down year or after a down year. So here's how cash value insurance comes into play. You're able to create a second pool of money through a whole life insurance policy that is not tied to an interest rate. It's not tied to the market. It's based on actuarial science. These mutual life insurance companies have been around for over 100 years. They use what's called the law of large numbers. They know when people are going to pass away, and they use that to their advantage. Because of that, they're extremely profitable. And in a mutual life insurance company, those profits go back to policyholders, you and me, which is a good thing. But because this second pool of money is no longer tied to what the stock market is doing, you have an opportunity for more certainty in your financial plan, for more predictability. Imagine having this second pool of money in your financial portfolio, and there's a stock market crash. You don't have to now take money from the stock market account that's down 30 or 40%. You can now take that income from the cash value of your whole life insurance policy. Imagine the peace of mind that that can bring, knowing that in a down market, you don't have to add salt to the wound by taking out income from a down account. You now can shift over and take that income from the cash value of the whole life. So let's look at the numbers and see how that actually works. I've pulled up a cash flow calculator, and we want to look at this illustrated over a 25-year time frame. So let's assume you're retired at the age of 65, you live another 25 years, and you've got a pool of money that you've accumulated. And just for round numbers' sake, let's use $1 million because it's easy to think about. Many people believe that the stock market has averaged a 10 or 12% rate of return. That's not reality, but let's look at that number. So I've pulled up market history, and I've chosen a time frame from 1970 to 1994, which is 25 years. And I'm going to use this 11.99%. I'm going to round up to 12% and use 12%. Now this is the S&P 500 with dividends, which keep in mind most people don't get dividends. Those dividends go back to money managers. So this isn't reality, but I'm going to use it for my example here today. 12%. So let's put this in here. It would seem to make sense then if you wanted to live off of 10% a year that you could. If you were earning 12% and only living off of 10%, that you're going to be fine. So 10% of $1 million is $100,000. So let's say this is your income. You're going to receive $100,000 a year in income from your stock market portfolio. And you look at this, at the end of 25 years, you were able to spend $2.5 million and still have left over $2 million to go to beneficiaries, your children, or a charity. So it all looks really nice. But again, this isn't reality. So what I want to do now is take the actual returns, not the average of 12% here, but the actual returns, the good years and the bad years over this 25-year time frame. So I'm going to copy those numbers and I'm going to paste them in. Here's what you'll notice. First off, the ending account value after 25 years is negative 2.6 million. Well, you can't even go there. Once you're out of money, you're out of money. You can't go to negative 2.6. So let's find out what happened. We see in year one, we were able to pull the 100,000, which is 10% from the million, but the account only returned 3.4% that year. Following year, we did better. It was 14%. So we pulled the 10%, 100,000, and it makes sense. But look in year four. In year four, the market is down 14%, and you pull 100 grand, your losses are compounded. You lose 130,000. And the next year is even worse. The market's down nearly 26%, and you need income still. So you pull the 100,000 from this, you're adding insult to injury. Now you suffer substantial losses that year of 175,000. So as you can see here, it's very painful to be pulling money from a down account. This is where the cash value life insurance comes into play. We use it as a buffer. I want you to think about this. We use the cash value in your portfolio as a buffer. This is one option of several options. It's not the only option. Having the cash value life insurance in your financial portfolio gives you many more options that otherwise you simply wouldn't have had. This is one option. So the rule of thumb is this. While having the cash value whole life in your portfolio, you're pulling income from your stock market investments. The year after a down year, you're going to take income from the life insurance policy. Because in a down year, you don't know that the year is going to be down. So you look 12 months back and you say, oh my gosh, I lost 14%. I better now take money from the cash value of my policy. So in year 5, instead of pulling 100,000 from the stock market investment, you're going to pull that 100,000 from the cash value. So we're showing this as 0. Year 5 was a down year also, so in year 6, we don't pull money from the stock market investment. And then finally in year 7, we're back to pulling 100,000 from the market investment. But again, we hit year 8, it was a down year. So in year 9, we do not pull from the stock market investment portfolio, we pull from the cash value of the life insurance. And then in year 10, we're back to pulling from the stock market portfolio. Now you'll notice, we only use the life insurance buffer 3 times, year 5, year 6, and year 9. But look what those 3 times did. You were still able to pull $2.2 million from the stock market investments, plus an additional $300,000 from the cash value life policy, and you still have $905,000 left that can go to beneficiaries or children or a surviving spouse or a charity. The point is this: by having the whole life insurance in your financial portfolio, you've been able to buffer against the stock market crashes and those down years of the market. This is one benefit of cash value insurance. There are many others. I encourage you to watch all the videos. If you find that this is something you want in your financial portfolio, reach out to us. Find out what's possible for you. As you can see here, there's more predictability. There's more certainty and peace of mind in your overall financial plan. You don't have to relegate yourself to all stock market investments and what the interest rates are going to be. You can create this second pool of money for safety, for liquidity, for certainty, and for peace of mind. I highly recommend you continue to get educated about the true benefits of properly structured cash value insurance. To learn more, visit us at wealthoptimized.com.